Hello, and welcome back to the channel. Today, we're going to dismantle the biggest economic myth in American history. Every student learns the same story about the Great Depression. The Roaring Twenties, wild stock market speculation, banks failed, unemployment soared, and Herbert Hoover got the blame. But what if I told you that story is a carefully constructed fiction? What if the real story, buried in the Federal Reserve's own archives, paints a picture not of an accident, but of a deliberate, controlled demolition? The evidence isn't hidden in some secret vault. It's in publicly available Federal Reserve Board meeting transcripts and policy records. These documents show the central bank didn't just fail to prevent the depression. It actively engineered the conditions for the collapse and then executed a surgical takedown of the American banking system. This wasn't incompetence. It was a plan. To understand how they did it, we can't start in 1929. We have to go back to 1921. After a short, sharp recession, the Federal Reserve opened the monetary floodgates like never before. They slashed interest rates, dropping the discount rate, the rate at which banks borrow from the Fed, from 7% down to just 3%. This wasn't a temporary fix. They kept the money easy for years. Between 1921 and 1928, the Fed expanded the monetary base by a staggering 60%. But where did all this new money go? Not into building factories or helping farmers. Fed guidance explicitly channeled this credit into specific, controllable areas: stock market margin loans and real estate speculation. While Wall Street was having a party funded by cheap credit, the agricultural sector, which employed a quarter of the country, was systematically starved of capital. The psychology was just as important. The public was told that a permanent plateau of prosperity had arrived. Treasury Secretary Andrew Mellon and President Coolidge themselves fueled this belief. Everyone was encouraged to believe that stocks could only go up. But behind the scenes, a different reality was taking shape. Corporate earnings couldn't justify the sky-high stock prices. Farmers were drowning in debt, and thousands of rural banks were already failing throughout the so-called prosperous 20s. Between 1923 and 1929, over 5,000 banks went under. The Fed watched this happen with a chilling detachment, making no move to help. They had created a two-tier economy, a speculative bubble in the cities and a silent depression in the countryside. By 1927, the trap was set. The public was aligned on the stock market, often with borrowed money. The banking system, especially in rural America, had been critically weakened. This stage was perfectly prepared for the next phase. In early 1928, the Federal Reserve slammed on the brakes. The policy reversal was so sudden, it could only have been planned. They began aggressively raising interest rates, doubling the cost of credit in just 18 months. But the real weapon was something called open market operations. The Fed started selling off its government securities, sucking hundreds of millions of dollars directly out of the banking system. In today's terms, this was like the Fed announcing it was removing $2 trillion from the economy. The effect was immediate and brutal, but not for everyone. Guess who knew this was coming? The big money center banks in New York. Internal documents show representatives from giants like National City, Bank and Chase had confidential consultations with Fed officials. They quietly pulled their money out of the market and moved into cash, positioning themselves not just to survive, but to profit from the coming chaos. Meanwhile, small community banks had no warning. They were trapped. They couldn't call in their loans without bankrupting their local communities. And they couldn't get new funds because the Fed had turned off the money spigot. The larger banks, now hoarding cash, wouldn't help them. Here's the most sophisticated part of the plan. Even as the Fed was tightening the money supply, the stock market kept soaring to new highs. This wasn't a paradox. It was the final turn of the screw. As credit became scarcer, speculators had to borrow even more aggressively on margin just to stay in the game. By mid-1929, margin debt was astronomical. Every single dollar of that debt was a landmine. The moment prices stopped rising, margin calls would force mass selling, which would drive prices down further, triggering even more margin calls in a death spiral. The Fed's own economists knew this. Internal memos from 1929 explicitly discussed the vulnerability of the market to a margin call cascade. They knew their policy would trigger it. They knew it would devastate the banking system, and they did it anyway. They spent years inflating the bubble, and now they were methodically deflating it. Throughout 1929, the warning signs were there for anyone with eyes to see. Trading volumes showed big institutions were quietly selling off their holdings. But the public narrative, championed by leaders and the press, remained one of unending prosperity. The trap stayed invisible right up until the moment it was sprung in October. What followed wasn't just a stock market crash. It was the intended outcome of a years-long monetary operation. As panic set in, people rushed to get their cash from banks. But the Fed, the one institution created to provide liquidity in a crisis, did the exact opposite. It refused to act as a lender of last resort and let the banks fail. Between 1930 and 1933, over 9,000 banks, 1/3 of all banks in the United States vanished with them vanished, the life savings of millions of Americans. This wasn't an unforeseen tragedy. The Fed's own records show they discussed and approved the policy of liquidating what they called inefficient banks. They weren't trying to save the system. They were purging it. The result of this purge was a massive consolidation of wealth and power. The surviving banks, the same ones that had gotten the advance warning, were able to buy up assets including rival banks for pennies on the dollar. Titans like JP Morgan and the Rockefeller-controlled Chase National Bank absorbed hundreds of smaller competitors, massively increasing their control over the American financial system. The wealth of the nation was funneled from Main Street to a select few on Wall Street. This is the story hidden in the Federal Reserve's own archives. A story of a boom, intentionally created and then intentionally destroyed. A story of a crisis, not of failure, but of success, for a powerful few. It transforms the Great Depression from a market accident into one of the greatest financial heists in history. It forces us to ask, who really benefited, and was the entire event designed to reshape the American economy for their benefit? The official story is comfortable, but the evidence points to a much darker and more deliberate truth. Thank you so much for watching. If you found this perspective valuable, please hit the like button, subscribe to the channel, and ring that notification bell so you don't miss our next investigation. See you in the next video.